Hi everyone, Mark Anderson here, construction worker turned zero DT hedge fund manager. And today I want to talk to you about how to create a portfolio that survives market shocks. If you've ever had a strategy that worked flawlessly for weeks, printing green day after green day, only to suddenly implode when volatility hits, then let's make sure that never happens again. Most traders try to optimize for profit in calm seas, but real traders prepare for storms. Building wealth is all about reducing risk. If your system can't take a hit, then you have a two-legged stool. It's just hope wrapped with confirmation bias. I don't just backtest theory, I trade these strategies live every single day. So let's talk about what really matters when things go sideways. Lessons from past market shocks. Before we get into how to build resilient strategies, let's look at what happens when you don't. Let me take you back to March of 2020, the COVID crash. The market gapped down so hard that stop losses weren't even in the conversation. If you were short premium, you weren't managing risk, you were just watching your P&L evaporate faster than you've ever seen before. Then there was Volmageddon, February 2018. The VIX spiked from 17 to over 50 in a day. If your strategy depended on low volatility environments, your entire edge vanished before lunch. And more recently, on the big Fed decision days, the option market turns. Spreads blow out, fills are terrible, and if you're not already in, or worse, if you're trying to get out, good luck. Here's the point. If your edge only shows up during low volatility, orderly markets, you don't really have an edge. You're taking 3 times the risk for the same return as just holding the index with 100 times the stress. It's like building a boat that sails great as long as there's no waves. And we both know markets come with waves, often way more frequently than we think. The 3 core principles of a shock-proof strategy. So let's talk about how to build a boat that actually stays afloat. There are 3 key principles I build into every zero DT system I trade. First, diversification of trade types. Most traders find one strategy, say short iron condors, and just run it into the ground. That's like betting on sunshine every day in the spring. It might work for a while until it doesn't. Instead, I build what I call a multi-weather portfolio. Short premium trades, like iron condors and credit spreads, for steady income. Long volatility trades, like back ratio spreads and straddles to benefit from large outside moves. Delta hedge trades, like balanced iron flies with protective wings to reduce directional risk. Trend trades of both credit and debit to profit from decay and to also profit from the delta on large directional moves. Each of these trades play a different role. It's like having offense, defense, and special teams in football. You can't win a game with just a quarterback. When the market shifts, at least one part of your playbook is ready for that specific condition. 2, smart scaling and position sizing. The second reason traders blow up, it's all about sizing. They build position sizes around what's supposed to happen, not what could happen. Here's my general rule of thumb for people. Never risk more than 0.5% of your account size on any one zero DT trade. Size down when the volatility picks up with a VIX of 12 is significantly different than a VIX of 25. Know how that environment changes and how your trades behave. If you are size too large, the time to size down is yesterday. Always know what your risk is and how you're exposed to the market conditions. If you realize you're exposed to a certain risk, fix it now, no exceptions. Use tranches. Don't go all in at once. Scale in. Layer your entries like steps, not leaps. Think of it like driving in the fog. You wouldn't hit the gas. You slow down, check your surroundings, and give yourself space to react. Trading is no different. You're managing risk, not chasing perfection. Knowing when not to trade. This might be the hardest principle of all. Discipline. The best traders come from knowing when not to trade. I sit out on days when market moves may happen. Think of large announcements like Fed rate announcements and when presidential press conferences take place during market moving hours. Unpredictability is high, risk to reward is very low. Trading at times like this, the bid-ask spread widens. Options are efficient and priced correctly when there is a competitive bid and ask. Before I enter any of my trades, my algo always checks the width of the bid-ask spread. If it's wider than my threshold, we don't trade, we skip the trade. Holiday sessions. Liquidity is thin and weird moves happen for no good reason. There's often little to no volatility on these days, so I trade significantly less and don't trade on some days entirely due to the confined session and hours of those trades. Just because the market is open doesn't mean it's worth participating in. Sometimes the smartest play is patience. It is easy to make money trading options when the sun is shining, but the real alpha comes from how well you protect yourself on the worst days. When volatility explodes out of nowhere, if you can limit your losses during those chaotic moments, you set yourself up to capitalize when the dust settles, on those big rebound days when volatility gets crushed. Warren Buffett once said, "You don't have to swing at every pitch in trading." Restraint is a position. How to prepare yourself for volatility. Okay, so let's say you've got the diversified playbook, you're sizing smart now, and you're sitting out of the nonsense. What else can you do to actually prepare for the chaos? Here's my 3-part checklist. 1, keep a hedge in place always. If all your exposure is short premium or your naked options, even when things are calm, I'll always keep long options in the background. Maybe some VIX calls, some deep out of the money SPX puts, and always long straddles. Not because I expect them to hit, but because when they do, they hit big and offset my losses. 2, simulate the worst case scenario. Backtesting for calm markets is like practicing only free throws in basketball. It helps until the game gets chaotic. Ask yourself, what happened if the market moves down 3% in an hour? What was the performance in your portfolio on the worst 5 days of each year, and what caused those losses? Does my data include all the data that is available to ensure we have a complete picture of what the worst case could be so we could protect against it to the best of our ability? And at what point do I become long options and volatility on a big move, so we know we stand to profit from continued moves instead of continue to experience pain and loss? If you've never tested it, you're not ready. Use stop limit orders instead of market orders. On high volatility days, market orders are just roulette. Stop limit orders give you much more control. They're not perfect, but they help you avoid major slippage. With a stop limit, you're exiting at the price you've defined and you're basing it off of the bid, what someone is willing to pay, not at whatever price a market maker is testing during a fast moving market. It ensures you're hitting the bid, not getting caught in the inflated spreads or price games that people are quoting. Again, it's all about planning for chaos, because eventually, I promise you, it will show up. Most traders blow up not because their system was wrong, but because their system was fragile. If your edge only exists in perfect conditions, it's not really an edge. It's an accident waiting to happen. So here's my question for you. What's the worst market move you've ever been caught in? Drop a comment below. I'd love to hear your story. And if this helped you think differently about how to trade, hit the like button, subscribe for more no BS breakdowns like this. And check out this video on how to make money during market chaos. It dives deeper into how I actually structure my 0DT strategy portfolios to manage risk across different volatility regimes. I'll see you guys in the next one.